This has been one of the busiest weeks in the market. We've had a huge portion of the S&P 500 report earnings, and we've had some wild reactions from different stocks. What I plan on doing in this video is something that I've never done before. I'm going to give what I believe is the best and most concise summary of 7 different earnings reports. 7 different companies that reported earnings this week and the key takeaways from each one. We'll be looking at Canadian Pacific, Netflix, Chipotle, S&P Global, Google, Microsoft, and Meta. We'll be going through each of these companies and seeing how things are developing fundamentally and what these companies are projecting for the future. So needless to say, this is going to be a jam-packed episode. We have a lot of earnings reports to get to, and we have some news items. One piece of massive news is the bill that we've been talking about for a long time, the one that aims at divesting TikTok from the Chinese government, has been passed. It was officially passed by the Senate and signed by the president, which means that they have limited time to divest or ban TikTok. And the CEO's response to all of this is to lie to you. We're going to be going over how the CEO is blatantly lying to the public. And then we also have news from the Wall Street Journal that Amazon and YouTube are bidding to pick up NBA sports rights. We'll be talking about that as well. So we have a lot to get to. Let's go ahead and get started. Let's start off with Canadian Pacific. This is a company that I bought into in 2023, and it's been one of the losers in my portfolio. By loser, I mean that it's not a company I've lost money in. I'm actually still in the green on it, but it hasn't been a big winner. It's actually underperformed the majority of my portfolio. So most of my stocks are doing really well. A lot of them are going up by a lot, and Canadian Pacific has just been hanging around the same price that I bought in. Canadian Pacific reported earnings earlier this week. It traded down 5.5% after earnings because they missed on both the top and the bottom line. Now, of course, I don't like when my stocks miss on both the top and bottom line, but when I look through the summary and the guidance that Canadian Pacific gave this last quarter, it was basically the exact same guidance they gave the previous quarter. They reiterated guidance for high single-digit revenue growth, double-digit earnings per share growth, capex of $2.7 billion, and a free cash flow conversion rate of 90%. This guidance that they gave in Q1 of 2024 is identical in every single way of Q4 of 2023. Well, in some cases, Wall Street has expectations that are a little higher. Wall Street probably expected them to raise guidance, so the fact that they just kept it the same was a disappointment, causing the stock to go down. But overall, when I look at the fundamentals of the company, the continued consistent guidance, I have a difficulty complaining about their performance. Canadian Pacific is, in a way, doing exactly what they said they would do. Nothing has changed from the management's perspective. So even though this wasn't the quarter we wanted, it wasn't one where the stock raced up 10% after earnings, as far as I can tell, I can find nothing fundamentally concerning about this company. Next up is Netflix. Netflix started out with a bang. They reported that they gained an additional 9.3 million new subscribers. Now, that was a huge beat over the estimates by basically everyone. Almost everyone in existence was expecting them to come in with less subscribers than that. In fact, Wall Street consensus estimate was that they were going to gain around 4.5 million. So they roughly doubled their expectations with subscribers, which was their biggest metric. Netflix also produced over $2 billion in free cash flow for the quarter. Total revenue grew by 15% year over year, and on a constant currency basis, it grew by 18%. Netflix also told us on the earnings call that they're still going to have over $6 billion of free cash flow this year, even though they're increasing their spend on content up to $17 billion. Netflix now has massive scale with a total of 269.9 million subscribers. This is at a scale that no other streaming company comes even close. Over the past year alone, Netflix has added 37.1 million subscribers. That is massive gains. In fact, that's the most that Netflix has ever gained in a 12-month period, aside from the one-time COVID environment. But even with these great numbers, Netflix stock was down over 10% after earnings, and it continues to struggle to get back up to where it was just a couple weeks ago. The reason that Netflix has traded down after this seemingly great earnings is because of a change in their disclosures. See, Netflix knows that they can't maintain this level of subscriber growth. Gaining 37 million in the course of a year is unsustainable. They also know that there's a good chance that they will have a negative subscriber number sometime in 2025 and beyond. By removing the subscriber metric from their quarterly report in 2025, They're removing the chance of a volatile earnings report because of a subscriber loss. That is what I believe is the primary reason for Netflix no longer reporting subscribers come 2025. See, even if Netflix does lose a couple million subscribers in the quarter, they're still going to generate positive revenue and higher average revenue per existing user. In this case, Netflix could lose subscribers. Let's say that they lose 500,000 subscribers in one quarter. Even if they did, they could still generate positive revenue and positive free cash flow, and investors would be none the wiser. See, what Netflix is doing by removing the subscriber metric is they're removing volatility from their stock. But ultimately, when I look over Netflix, the company is the same company before earnings as it is after earnings. The change in disclosures over subscribers is a change in tactic to help the stock become less volatile, to avoid going through something like this again. This was not fun for Netflix employees or shareholders. So they're trying to make the stock less volatile by removing that volatile metric. I believe it's very likely that the Netflix executives and the Netflix team still believes there's a huge opportunity out there, and they want to go after that opportunity, but they also want to address volatility in the short term. So for me, I view this change in disclosures as a tactic change to lower volatility, not as a fundamental change in the thesis of this company. Next up, we have Chipotle. Chipotle just recently reported earnings, and it was a beat on the top and bottom line. The stock is up now 10% after hours, moving up to almost $3,200 per share. Revenue grew by 14% year over year. Same restaurant sales increased by 7%, and they opened up 47 new locations in the quarter. Free cash flow is up 30% year over year. Earnings per share jumped by 24% year over year, and operating margins went from 15.5% to 16.3%. So operating margins increased by an incremental 1%. Another thing to mention on the earnings per share growth of Chipotle is it looks really fast as it is right now. Earnings per share grew by 23%, but they note on the earnings call that they had a one-time tax event. If you adjust out that one-time tax event, the earnings per share actually grew by 27.3% year over year. So that's actually a more accurate way to look at their organic earnings per share growth, growing 27%. These are extremely strong fundamentals from a company that continues to beat Wall Street's expectations. Now, on top of the previous quarter and all of this growth that they just recently had, they also gave very strong guidance. They reiterated their full year guidance of same-store sales rising in the high single digits in 2024, and they plan on opening up 285 to 315 new locations. With a high return on capital and a large amount of reinvestment, that equates to a company that will grow its earnings aggressively over the next 5 years. So even though the PE ratio is high, and at first glance it does seem a bit alarming, we need to put that in context of how much the company reinvests and the returns they get on those reinvestments. And I think given that context, Chipotle is not quite as expensive as it appears. Now, again, I'm not trying to say it looks cheap here. It's not a company that I'm buying hand over fist right now. I bought the company when it was $1,900 per share. So I bought it a bit ago at a lower price, and right now I'm just holding. Next up, we have one of my largest positions, which is S&P Global. S&P Global beat on the top and bottom line, which is typically what they do. The stock traded mostly flattish after earnings. Revenue grew around 10% year over year, and every segment of their business is growing above 7% or more. Earnings per share grew by 28%, and something I really like to see from any company is a raise in their free cash flow guidance. Free cash flow increased by 63% year over year, but that's kind of like a one-off quarterly thing. They said that overall, they're raising their guidance from $4.4 billion in free cash flow this year up to 4.5. So we have a nice slight raise in free cash flow guidance. And they expect to return 80% of that 4.5 back to the shareholders, which comes out to around $3.82 billion being returned back to you. And of course, the way that they return that back to shareholders is either through dividends or buybacks. We can see that they are buying back shares rather aggressively. This is the big spike after their recent transaction, and they're starting to reduce the amount of shares outstanding ever since. Overall, when I looked at S&P Global's earnings report, it's what I describe as business as usual. There was just no changes. It's basically the exact same report as last quarter, but a few minor changes in guidance. So as for me, nothing really changed this quarter in regards to S&P Global. Now, next up, we have a big one. Google reported earnings yesterday, and to many people's shock and surprise, the stock raced up 10% after hours. So let's go ahead and take a look at what caused investors to get so excited about Google. First of all, we have the total revenue for Google growing at 15% year over year. So that's the total company, but there's some breakdowns we want to get into here. If we look at Google on a revenue basis, we can break it down by segments. Now, this is something that isn't public on Qualtrim yet, but it's going to be very soon. We can first start by looking at the Google search business. Search is exactly like you'd think. You search in something and Google runs ads on it. This is a massive business, but it's not growing all that fast. It is growing over time. We do see steady growth, but it's just a bit slower. When we move over to YouTube advertising, we saw quite a bit of growth last year. Right here, we had $8.09 billion in YouTube ads. If we go back 1, 2, 3, 4, it was up almost 25% from $6.69 billion. That's a nice, healthy increase in YouTube advertising. Then if we look at Google Network, this is like their ads network where they run ads on different websites. This is also growing, but it's not the fastest growing portion of the company. You can see that it's mostly flattish. So even though this is a huge part of Google currently, it's not the fastest growing part. When we get over to the subscriptions, this is like all of their Office subscriptions, YouTube Premium, anything that you subscribe to under the Google bucket. Now, the subscriptions is seeing healthy growth. $8.74 billion in subscription revenue last quarter. That's compared to $7.4 the year before. But then we move on from subscriptions to the other big category for Google. And this is one that I think is incredibly important to Google. The cloud revenue growth. Take a look at this chart over time, going up every single quarter without fail. If we go back just 4 quarters ago, it was $7.45 billion. Then this most recent quarter, it's $9.57 billion. So this is where Google's getting a tremendous amount of their growth is from the cloud. And I've been trying to say this for a long time period. The biggest parts of Amazon, Microsoft, and Google are continually going to be the cloud businesses. These are such reliable businesses for these companies. Now, this cloud portion does make up a small portion of their overall revenue, but it's growing in importance because the cloud revenue operating margin is also increasing as it's growing. You can see the increases over time in operating margins. And this most recent quarter was the same as the previous one, 9% overall. But I believe you're going to see a healthy trend year over year as operating margins climb. Now, another thing they did on the call was they initiated their first dividend. We can see in the dividend category here, Google has literally never done a dividend. So that's very exciting news for dividend investors. And I think any investor that wants more cash returned to them. Google has had a problem with hoarding too much cash. They're not going to be able to spend this cash. Regulators will not let them purchase large companies. So this needs to be either reinvested at a high return or returned to the shareholder, which is more likely. And since Google has all the money they could possibly reinvest at a high return, they have more than enough money to pay both a dividend and do continued buybacks. And they did also approve another massive share buyback program of $70 billion. Sundar Pichai is also taking things seriously. The employee count is relatively flat. In fact, it's gone down year over year, and it shows that he's curtailed the excessive hiring problem that he had in previous years. Google has reined in their hiring practices. And on the earnings call, the CFO said that Google's going to have higher margins next year while increasing their incremental investment into AI, which is exactly what investors should be wanting to hear. More investments into AI while getting higher margins. The net income this company's generating is now coming from more sources. As we've discussed, the cloud is growing quickly, but with the margins going up for cloud, the actual operating income from cloud is going up exponentially. For example, 1 year ago on this same quarter, Google Cloud made $191 million in operating income. This quarter, it made $900 million. That is a 371% increase in operating income for the cloud year over year. And it seems like investors are now accepting the vision that the cloud is going to be a long-term secular trend of growth for Google. Overall, this was a fantastic quarter for Google. I have a difficulty finding too many things to complain about. I believe the stock deserves to be up more than it is. Next up, we have Microsoft, which has been a big position of mine for quite some time. They just reported earnings along with Google after market close yesterday. Microsoft beat on the top and bottom line, as you'd expect from this company. Most of the time they do beat their earnings estimates, but there were some more surprising things that happened in this report. Total revenue grew by 17% year over year to $61.86 billion in a single quarter. Earnings per share climbed by 20% year over year. Free cash flow grew by 17%. These numbers are very fast for a company as large as Microsoft. We're talking about a $3 trillion market cap company that's growing free cash flow and revenue and earnings per share in the high teens. This is faster than a lot of startups grow. Microsoft Cloud grew by 31% last quarter year over year. And then they guided next quarter to grow the same, around 31%. They also said that there's so much AI demand that they don't have enough server capacity to meet it. So they're having to increase their incremental investments into AI, similar to what Meta's doing and similar to what Google's doing. All of these companies are saying that there's a ton of AI demand that they need to get supply for. This was a great quarter for the cloud companies. Both Microsoft and Google had very strong results driven by cloud. Now finally, and the most perplexing to me, is Meta. This is a company that, as far as I could tell, overall, the earnings report was very solid. In fact, I thought it was actually just pretty good. The earnings report was better than I expected. But regardless, this stock fell by 15% on the day. It's now down 11% over the trailing month. And there's articles of Meta losing more market cap in a single day than any other company. Now again, when we look at the actual numbers here, they're really good. Meta's revenue grew by 27% year over year. Free cash flow is up 79% year over year, and earnings per share came in at an increase of 114%. Now, obviously, investors had priced in a lot of that earnings per share increase. It had a huge dip in 2022 that they're benefiting from with this metric, but either way, these are all strong metrics. The thing that caused Meta to sell off was commentary on the call. This entire $200 billion market cap loss for Meta is almost entirely due to the way that Mark Zuckerberg spoke about the company in his opening remarks on the earnings call. We have a report here from CNBC. Mark Zuckerberg started Meta's earnings call by talking about artificial intelligence. Now, that's not the problem right there. Lots of companies talk about artificial intelligence, and most investors can get behind that. They like AI, they like cloud computing, they like those type of words. But then he moved on to the metaverse. Investors are not quite as keen on the metaverse. They're not quite as bought into that dream as Mark Zuckerberg. But Mark Zuckerberg continued to talk about the metaverse, touting his company's headsets, glasses, and operating system. And then he spent almost the entirety of his opening remarks focused on the many ways Meta is losing money. It's almost as if he wants the company to go down in market price. Maybe that's his goal. Maybe he's trying to tank the stock so he can do buybacks. But either way, investors weren't into it, and Meta shares stumbled as much as 19%. Now, right now, I don't own Meta stock, so this is not one that I have any money in. But if I was a Meta investor, I don't see any reason to become less bullish after this quarter than you were before. Now, that's going to be all the earnings reports that wrap up this very busy week. Let's go ahead and move on to the news. The biggest news of the week is the so-called TikTok ban. This bill that we know has been making its way through the different levels of government. It made it through the House, then it made it through the Senate, and then just recently, it was signed by President Biden, meaning that TikTok has two options. Either they divest the majority ownership and they retain only 20% ownership of TikTok, and they let the rest of it be owned by American firms, or it's banned. They either have to do that or pay a massive fine on a per user basis, which would be north of $800 billion per year. So effectively, TikTok has one of two options: to divest the majority of the business, or it's banned. Now, there's a lot of ways that the CEO of TikTok here could have responded to this conundrum. There's a lot of things he could have said. There's a lot of opportunities here, but this is the way he chose to address it.
Hi everyone, it's Show here. As you may have heard, Congress passed a bill that the president signed into law that is designed to ban TikTok in the United States. That will take TikTok away from you and 170 million Americans who find community and connection on our platform. Make no mistake, this is a ban on TikTok and a ban on you and your voice. Politicians may say otherwise, but don't get confused. Many who sponsored the bill admit a TikTok ban is their ultimate goal. It's obviously a disappointing moment, but it does not need to be a defining one. It's actually ironic because the freedom of expression on TikTok reflects the same American values that make the United States a beacon of freedom. TikTok gives everyday Americans a powerful way to be seen and heard, and that's why so many people have made TikTok part of their daily lives. Rest assured, we aren't going anywhere. We are confident and we will keep fighting for your rights in the courts. The facts and the Constitution are on our side.
Now, he so far has highlighted a few things that I think are worth pointing out. At the very beginning of this clip, he mentions that this is a TikTok ban, even going so far as to clarify that this doesn't mean anything other than a TikTok ban.
Make no mistake, this is a ban.
Now, there's no easy way to put this other than this is just a complete lie. It's a complete false dichotomy. What he's done here is multiple times lied to everybody with this video. The bill that was passed has multiple options. It would force TikTok to either be sold to a US firm where it's controlled by the US or banned. So there are multiple options here. What he's doing by saying, make no mistake, this is a TikTok ban, is creating a false dichotomy. That either TikTok's banned or it's not banned. That there's no room in between. There's no other option. When there's an obvious, blaring option, an alternative to the ban, which is to simply make tens of billions of dollars by selling this asset to the US. Now, the craziest part of this news is not the CEO lying to your face, creating a false dichotomy, but it's the parent company, ByteDance, the Chinese company that owns TikTok, has stated that it has no plans to sell TikTok in the US. Meaning that given the choice between selling this asset for tens of billions of dollars, having the company make tens of billions of dollars in profit by selling TikTok, they would rather just have it banned outright. Over my years of looking at companies almost full time, I can find no other example of a normal profit motive company to simply choose having something get banned and making no money over it rather than divesting it and selling it for tens of billions of dollars. Can you find one single example of a company ever doing that? One exhibiting this behavior? They're exhibiting behavior showing that they don't have a profit motive. Why does TikTok operate in the US if it's not to make money? Now, the statements from ByteDance and the false dichotomy that the CEO of TikTok is making could just be positioning. Maybe they're trying to play hardball because they really don't want to divest the company, and in the end, they'll finally succumb to divesting it. But it is odd behavior. A normal company would never choose to have their asset banned rather than selling it for tens of billions of dollars. That's not something a normal profit motive company would ever do. So when I look at this news, I become more skeptical when the CEO of the company creates this false dichotomy. And I become even more skeptical when the company itself that's owned by China says that they will not sell to a US firm. That makes me question the entire motives of the company doing business here in the first place. Now, finally, we get to the news that Amazon and Google are starting to take away major sports rights from the previous owners. And this is something that I predicted will happen over time. Amazon and Google are going to steal sports from their traditional holders. The traditional holders are ESPN, that's owned by Disney, TNT's Warner Media. The NBA is realizing that when they have more viewership, they sell more jerseys, they sell more ads. When they have more viewership, it's good for the league. And the companies that have the most viewership now are companies like Amazon with Amazon Prime and Google with YouTube. These two companies not only have the most viewership, but they have the most money. So it's only a matter of time, in my opinion, until Disney and Warner Media Bros. Start losing these streaming rights. I think it will happen eventually. I don't know if it will happen in this go around, but I believe it will happen eventually. But that's all for this time. I hope you enjoyed, and I'll see you in the next one.